Hello, everybody. Happy 2025 and welcome to the Lowdown. Today, joining me is Kevin Lenox.
Happy to be here.
Well, Kevin, I thought we'd start off talking about the markets have been extraordinary. I think, everyone is talking about how much they're making in the markets. I mean, for the last, 2 years, the S&P 500 is up over 20%. We haven't seen this since 1998, 1999, which we could talk a little bit about that as well, what that means. But for the most part, 90% of those that have Robinhood accounts haven't seen a bear market. That's pretty scary. And the old adage, and I'll let you say it, but I mean, this over the holidays, I think every Uber driver I have was talking about how much they're making in stocks, they're making in crypto, and just about everything else. But I thought I'd just get your thoughts or potentially your caution on what's happening here.
Yeah, the exuberance has been widespread, and
Yes.
partly based on good fundamentals.
Very
We've had
true.
above trend GDP growth.
Mm-hmm.
Corporate earnings have consistently surprised to the upside. The Mag 7 stocks get all the credit. They were up. They account for almost half of the gains.
Wow.
Over the past year. So it's been a concentrated market. And then we have a Fed that really wants to continue cutting rates. Now, the Santa Claus rally we were supposed to have didn't quite materialize. It
Sure.
wound up being a dud.
Yes.
Because all of a sudden inflation reared its ugly head, or the potential for more, which we talked about the last time. We made a case for more stickier type of inflation.
Yes.
That was not in the narrative. And with the ISM services report yesterday, the prices component went up from, it's a diffusion index.
Okay.
So 50 is considered neutral.
All right.
It went from 58.2 to 64.2.
That's a big jump.
That's a big jump.
Yeah.
And that caused a sell-off in the bond market. And hey, wait a minute, maybe prices are going to be stickier for longer, and then that keeps the Fed on hold. So the Fed meets at the end of this month,
Okay.
and now all of a sudden the assumption of 4 rate cuts has been whittled down, and the chance of a rate cut in January is down to about 10%.
Well, that kind of gets me into the next, kind of thought is just talking about what do you think some of the potential headwinds that could derail this positive outlook? And I think you just mentioned one of them, a potential comeback of inflation. Give me your thoughts on that, and maybe what other ones are you thinking that might be potential headwinds?
Yeah, we'll continue to make a case for sticky inflation that gravitates around the 3.5% range. The deficit spending is likely to continue. There's a lot of
True.
uncertainty regarding the fiscal policy outlook right now. So that within the House, we talked about this big red wave.
Sure.
And less regulation, pro-growth business policies, tariffs would take care of the deficits. It's more of a clouded view.
Sure.
So by the time inauguration comes around, the Republican advantage in the House will only be 217 to 215.
So not a huge lead.
And then you've got the Freedom Caucus in there, about a dozen members,
Okay.
which are very concerned about the deficit. And the only reason Mike Johnson is Speaker is because he agreed to basically not increase the deficit.
Okay.
That's not on Donald Trump's agenda.
Yeah. Yeah.
So the extension of the tax cuts and other pro-business policies are a bit clouded now, and that's got the market on unstable footing. So the Santa Claus rally becomes a dud, and we're about 3% in the S&P off the all-time high.
So I've been getting this question a lot, kind of the outlook. For one, personally, I put a lot of my 401k, I front loaded the first half of the year, and I'm putting that money kind of in cash for now. I've had my normal allocation. I'm not changing that. But one of the reasons I think, with the Department of Government Efficiency, which is basically Elon and team, there's going to be a lot of volatility. And I would expect a lot of volatility as if you're going to go in and basically overhaul government, the markets don't like uncertainty. That is going to create the biggest amount of uncertainty. Now, the only thing that maybe trumps that is global liquidity, which has been very strong, and global liquidity is probably maintaining pretty strong. But I think things are going to change. This is something that none of us have probably ever witnessed. It's something well needed, as we all need, but it's not going to be your normal type of beginning of the year, your normal type of markets responding to this major change. But I thought maybe, another one that I would think of is basically valuations reverse. I mean, Palantir right now trades at 60 times revenue, which, I mean, I don't know. You might want to explain that to somebody, but it's difficult to see how these valuations remain where they're at longer term. So that's definitely one. And I don't know what are the thoughts of some of the other things that could kind of derail this optimism we're seeing in the market.
Sure. So we'll start with, I guess, the Mag 7, which has been the most talked about. So
sure.
They accounted for almost half the return in the market. So one thing that we're watching, and was an important metric to watch in the late 90s, was changes in revenue expectations for the hyperscalers versus CapEx. And we've already seen CapEx starting to outstrip revenue forecast gains. And does that continue? That could be a big headwind. And if there's a correction in the market or a rotation out of the Mag 7, that would cause consternation probably throughout the rest of the market and a revaluing. Overall valuation-wise, basically every metric people look at
is through the roof.
Shows a market that's overvalued. One of the things we'll always concerned about is, are there signs of the consumer cracking? Always look at that super tight, and really don't see the evidence. Obviously, the lower income households are really feeling the pinch.
Sure.
Cumulative inflation is up about 24% just over the past 4.5 years.
Yeah.
But does that start to move upstream and envelop more of the middle class?
I think a big one for me, and this is one that you can elaborate on, but I've been hearing a lot, is everyone thinks rates are going to go lower, right? So we've been hearing, rates are going to go lower. The Trump administration is probably going to get it in there, beat up Powell or whatever to get rates to go lower. But I think one would be that the expectations of rates going lower, but they may not go lower for long, or they may not go low at all. And I think that could be a really big problem.
Yeah, there's a lot of assumptions around rates going down. And I will say one of the Achilles heel I think is out there is in private credit land, in that the assumption is that rates go down, that eases the debt financing costs. But if rates stay sticky, it's worth noting that between the leveraged loan universe and the high yield loan universe, high yield bond universe, there's about 10 million employees. And if rates stay higher for longer, those floating rates and bonds, reset at a higher level, there's going to be more financial strain that could lead to layoffs. But then it's something wider than that. So that's a key thing we're watching very closely. May or may not materialize, but it's a potential canary in the coal mine.
So Kevin, probably the last thing I'd throw in there that could kind of derail this optimism is obviously we've heard of the Trump's tariffs. I mean, I think he's definitely been out there pushing tariffs, talking about the tariffs. That supports the America First agenda that he's have for since he took office the first time, and of course now potentially about to take office a second time. But I think people have a big misconception on what he means by tariffs. Maybe you can kind of clear that up, or at least explain why that might be something that derails this.
Yeah, it's like the overwhelming opinion is that tariffs are automatically inflationary, and I'll take the contrary side to that, in that if you don't have the Fed creating new money, if you don't have increased deficit spending from Washington, then an increase in a basket of goods that a consumer buys, if that goes up by 10%, 20%, yet wages only go up 3%, that's a problem.
That is a problem.
That is disinflation. That's just money that comes out of another expense item.
Yeah.
So assuming everything is inflationary, that's not quite right. But there's different ways of doing tariffs, and I would argue too that some of these tariffs are really the starting of a negotiation.
Well, that's exactly right.
So it's not just the blanket across the board tariffs, which sounds scary. Trump is a businessman first, a deal maker, and he's not looking to hurt the economy or the stock market.
I mean, it'd probably be smart if some of these foreign leaders would read Art of the Deal. They know exactly what these tariffs mean, and I think you're exactly right. It's there as a negotiating tactic, and you know what? They're listening. I mean, you saw what happened with Meta yesterday. I mean, he's got everyone scared, from business leaders inside the United States to foreign leaders of countries. They're paying attention, and I think that's why he means business. And well, he's probably going to get a lot of what he wants. So we'll see, but that's going to create, like I said, market uncertainty for sure.
Yeah. So it's nice to have the rosy outlook, but there are certainly things to watch. We're likely to have some, I would argue, more volatility this year than last year. The S&P only had a max drawdown of 8%.
Wow.
We typically have at least one correction, which is 10% a year.
Yeah.
And with the heightened expectations now around inflation, then we're more likely to get that this year. Plus just so much confidence in the Mag 7 to continue carrying the market.
Well, and that scares me, not having normalized corrections. You get this euphoria, this optimism that we're seeing now. I think I just heard the other day we had a 3% correction and somebody was calling it a crash. So I mean, it's just pretty sad. Well, here's another one a question I have for you. So we saw the rate cuts that we had by the Fed, but basically it looks like we basically zeroed that out with the actual rate increase, a 100 basis point rate increase. What does that tell you? What is that supposed to mean?
That is the question of the year. The Fed declares victory over inflation in September of last year. They had what equates to an emergency cut of 50 basis points. They cut 2 more times. So 100 basis points in cuts. And what does the 10-year Treasury yield do over that exact same period? It goes up 100 basis points. So why is that? Is it concerns over fiscal policy? Is it concerns that maybe the Fed cuts shouldn't have taken place in the first place?
Yeah.
Because the rate hikes that we had really didn't tighten the economy that much, because companies and households refinanced their debt,
Sure,
extended the maturity, so we didn't have the normal cycle effects. And then the third one that's out there, and we got some good news on this today, was the level of foreign demand for U.S. Treasuries. Does that start to wane? We had the 30-year Treasury auction today, which a lot of eyes were on. I normally don't watch auctions. Nobody does.
Okay.
But this was $119 billion coming this week.
Yeah.
And the longer-term maturities are more sensitive. And it went off fairly well. The foreign demand was only slightly off of the 6-month average.
Well, and I think just goes to show you right now, where else is there to put your money, right? I mean, as far as looking at foreign buyers, where else are you sticking? What other currency? You get a lot of discussion on the U.S. dollar, not being the strong safe haven. Well, you're just going to have to show me a clear, at least for now, what's a good clear second. I don't think there's much out there. So,
so the 60, as well as the stock market did, the 60-40 portfolio did not do as well last year because of the bond side. The benchmark aggregate bond index was only up 1.3% last year. Money market, on the other hand, was up almost 5%. So for the past 1 year, 3 year periods, money market has handily outperformed the aggregate bond index. This year, we'll see. It could be the same, but it's worth looking beyond. It's worth rethinking the 40 part of the 60-40 portfolio.
Well, we've been talking about this for a while, though. We've been talking about the alternatives. I mean, for as long as I can remember us doing the podcast back to the radio show days. So I think that, that's something that we believe that model has changed. But sometimes within a 401k, it's a little hard to find that alternatives. You kind of have to stick to a stock to bond only type portfolio, which I hear that may be changing depending on what they lobby Congress in terms of putting private equity in 401ks. We'll see where that goes. But I hear that's coming.
We've been talking, the last, as long as we've been doing this show, about a preference of U.S. versus foreign.
Yep.
Large cap companies with strong balance sheets, versus mid and small size companies. That continues to work. And then on the bond side, more of a bear steepening type of call where short-term rates are a little bit anchored by the Fed. But the 10-year Treasury, which the Fed has nothing to do with, that's dictated by expectations of growth and inflation, that has gone up. And that's what's hurt the aggregate bond index. So, with that, we've been recommending, and, fortunately, knock on wood so far, and I think it continues, more short to intermediate term credit investment grade versus a normal allocation to intermediate treasuries, I think makes more sense.
So, Kevin, I thought we'd end the show. We're talking about oil. Obviously, we're in Houston in Texas, a big oil state. So I think it's probably good that we talk a little bit about it. But by the way, have you seen the show Landman?
Yes.
You have? Okay. I tell you what, they casted that well. Billy Bob Thornton, I'll just give him kudos. Amazing job. That's where my family's from. I mean, my dad and his two brothers were basically the workover rigs. I mean, everything you see in that show is what my dad's side of the family's done. So it brings back a lot of memories. But we've got some, some new discussions of new types of energy plans. I know the new Treasury Secretary, Scott Bessent, has talked about a plan, and I know you're pretty much on top of what that is. But what are they talking about? What are some of the things you hear they're discussing, and how is that going to affect oil?
Yeah, so Scott Bessent is the new Treasury Secretary, Wall Street guy. Mm-hmm. And he came up with a 3x3x3 plan.
Okay.
Probably got him the job. And one is to shoot for 3% GDP growth.
Okay.
Through pro-business growth policies, less regulation. The other is to cut deficit spending to 3% of GDP from 5 to 6. Mm-hmm. And then the third is to increase oil production or energy oil equivalent by 3 million barrels a day.
Okay. All right.
Most have said that's not really doable. But the idea is that drill, baby, drill, get oil prices down, and that takes the edge off of inflation.
Well, sounds better than drill, baby, drill. I've always hated that. Just thought it was too aggressive. 3x3x3 might make a lot more sense.
Yeah. But so sentiment has been terrible for oil.
Yes.
Through most of last year. So Landman maybe helped at least a little interest maybe in the sector.
They've put a lot of facts out there in that show, which I think are pretty good. People need to watch it.
Right.
Listen. Yeah.
But bottom line, we're expecting another year of excess supply relative to demand.
Okay.
But demand isn't going away.
No.
The technology to increase supply has improved at a much, much greater pace than technology to decrease demand.
Well, we're definitely in trouble when you look at artificial intelligence, AI, the amount of GPUs that are going to be demanded from here to 2030. I mean, I think we're going to triple that. If something isn't done, the cost of energy could go through the roof, right? And so I think that's why you're seeing, and thank God for this awareness that we're going to need, more supply than I think many people think.
Yeah, the longer term route for clean, dependable, 24/7 energy is nuclear.
Yes.
That's going to take a while, but we saw each of the hyperscalers do a deal for nuclear power in Q4 of last year.
Well, it's funny you mentioned nuclear. I was at Valerian Space Ventures. They had a nuclear conference in Dallas. So actually, I introduced Isaiah Taylor. So he owns a company called Atomics Valar. His company and several others are making the SMR, small modular reactors. So when people think of nuclear, I mean, everyone thinks of Chernobyl. Everyone thinks of this big reactor, what happened in Japan. But I think that is a very good alternative. As a matter of fact, it's going to be big in terms of space exploration and defense. And naturally, what we know it here in Texas. We know what happened to our grid. So all these things, I think that is going to be a pretty positive. But to your point, it's going to take about 2 years for the deregulation to occur to actually get these online. Probably another 3 years, if not a little bit more, to actually get that produced. So we're looking at a good 5-year, 6-year gap before that's probably feasible. So demand's going to need to come from somewhere, and there's only probably one spot. And to your point, what you said earlier about increasing energy demand.
Yeah. If Google were to employ the same level of search capability that ChatGPT has,
okay,
it would require 10 times more energy.
Yes, that is a big problem. So, well, look, great to start off the year. I know we're going to be talking and having much more podcasts and keeping everyone informed. But we'll see how 2025 is going to be. But it's going to be it's not going to be boring, that's for sure.
It will be interesting.
All right, Kevin. Thank you.